Thank you, Jalapa, for inviting me back. It's been really great to be here in person, at this great conference. And the one thing I would promise the audience that we are not going to talk about crypto at all in this session. That's a promise. So my name is Quan. I'm founder and general partner of a venture capital fund called Nevcaut Ventures. We primarily invest in pre-seed to up to Series A, insurtech, fintech, insurtech startups. It is my great pleasure to have a conversation with Kenneth, my friend. So I got to know Ken when I was still with the government, and Ken and I share the same, cultural and ethnic heritage, and we also understand and appreciate the challenges and opportunities for first-generation Americans, immigrants in this country. And so there's, about 100 million members, Credit Karma users in the United States, and a lot of people know Credit Karma, but not that many people actually know Ken's story. So Ken, tell us about, your upbringing and how that really shaped your worldview and how that really sort of ultimately later in your life after, went to college, having a few things at startups and end up building Credit Karma.
Sure. Well, first, Jalapa, thank you for the invitation and putting on this great event. Dan, thank you for telling me to bring a suit because I would have probably shown up in flip-flops in any other day. So, to your question, I think this is one of the great influences in my life. So, I came from mainland China when I was 4 years old. And I ended up in Las Vegas, of all places. And, coming to a country looking for opportunity, but also not speaking a lick of English. And I guess in many ways, I saw the financial system as from the outside. And I think that is in many ways what influenced both my upbringing, but how I thought about the opportunity that Credit Karma had, but maybe some of my worldviews on what we could do to be more inclusive when it comes to financial services. And, to give you a sense, we came to the United States, lived in Vegas again, but, my parents worked multiple jobs. My parents were on food stamps at some point. So, I think in many ways I am a byproduct of the system, and those social safety nets really work. So if you work on those programs, please know that they do work. And I'm a huge supporter of what we have in that context. But to that note, I think more than anything, my note from my upbringing and how it affects how I think about Credit Karma is, the financial system is great if you're already in it. But if you're not, there is a lot of opportunity for us to be more inclusive, to build network systems and tools that sort of bring people along. And I think technology is the great leveler in this space. And I hope that the people in the audience, the people on Zoom sort of appreciate that and encourage more fintech, because I think that is how we create more inclusion and how we ensure that there is upward social mobility. I've lived the amazing sort of American dream story, but I want to make sure that everyone else can too. And I think, the people in this room and in the call have great impact on that.
Great. So this is really a good segue into our first question about financial inclusion. This is something you are, very passionate about. And I'm sure a lot of people in this room, whether you're in government or you're in private sector, you're passionate about financial inclusion. So, it's a cliche that it's expensive to be poor, right? So, but we have also seen tremendous, progress made in the last, decade, but still, Americans are not financially healthy, right? So I'm looking at some numbers. There's a CNBC Your Money Financial Confidence Survey from 4 months ago that shows that 58% of Americans living paycheck to paycheck, and roughly 70% feel stressed about their finances. And the Lending Club had a similar survey every year, and they show similar results. So the question for you, Ken, is as much as the promises of fintech has given to for more financial inclusion. What can fintech do collectively, and also not just fintech, but also regulators, policymakers in this room? What can they do? What's your advice for them?
Well, I think it goes back to a lot of what consumers really face from a challenges perspective, right? There was a lot of crypto conversations, and not to rehash it, but this idea of what problem are we solving? And I would note that there are very real problems when it comes to financial services, right? So just think about lending in general and the challenges associated with it, right? What product out there exists where you don't know the price of the product, you don't know what your credit limit is going to be, you don't even know if you can buy that particular product until you apply, right? And that, in my mind, doesn't make any sense in context of the amazing technology that we have. In the last 20 years of innovation, We have Uber, we have GPS, we have, amazing technology on every front, but we still lack it from a consumer perspective, right? A consumer lending perspective in the financial service system. There have been amazing financial services products, right? So if you think about all the derivative instruments that have been created, the financial instruments, there is amazing innovation on asset-backed securities, you name it. But when you think about it, the consumer experience in the most underserved, underadvantaged, disadvantaged consumer segments, what innovation has there been? And I would hope that regulators will create room and space to allow more companies to flourish in this space, to bring access to those who are, least served. I mean, you talked a little bit about, it's expensive to be poor. I mean, one of the most profound things that I've done, and I encourage everyone in this room to do it, is there's a program called, with a CFSI, where you go out and you understand the plight of somebody who doesn't have access to the financial services system. So what they did was they asked a consumer, or asked me or the group who actually participated, to go to the tender line. And here's a check. It's $100. It's a funded check. But don't use your existing banking accounts to cash it. And what you realize when you stand in line at a check cashing place for an hour, where you could be spending time with your kids, where you could be at work, where you could be doing something productive, you're standing in line to get your check cashed. And when you get to the front of that line, somebody's asking you to pay for 9% of that $100 check. And that idea of it is expensive to be poor. It is expensive to be excluded from the financial services system. I mean, I think those are great opportunities. And we have to think about, FinTech has to think about ways to be more inclusive, to allow more innovation in this space. Because I think that, the income and, wealth disparity continues to increase over time. And I think the people in this room have the greatest impact, because I think a great many companies want to solve these issues. But it's hard, right? Because there are so many regulations at times that actually prevent some of the innovation that needs to happen in the space.
So do you think, I mean, obviously, one of the things that I think a lot of regulators, policymakers, and the fintechs are fighting, for example, there's a sort of a short-term cash flow mismatching problem, right? So a lot of people traditionally resort to expensive payday loans, overdraft fees, and the CFPB has declared war on junk fees, since last year. So, but there are certain market solutions to help solve the problem. Obviously, the best way to solve the problem is put more money in people's pockets, but that's not going to happen, right? That's a much bigger problem, than financial services. But to the extent that, do you think there are opportunities for regulators to really maybe look at these new products and instead of applying sort of existing rules or laws to try to regulate them the same way as those sort of more predatory high cost products? What sort of opportunities are there for regulators to really think sort of outside the box and promote the better products?
Well, you mentioned an amazing stat, right? Which is something like, a quarter of all Americans live paycheck to paycheck. So the cash flow issue is real. And when it comes to things like predatory payday loans, we are completely against them. I am completely against them. But you have to think about the use case in terms of there are consumers who, if they do not have access to cash, their electricity is going to be disconnected, and that's going to be a $500 fee for them to get reconnected. And what are the right solutions? So certainly predatory payday loans or, short-term loans that are usurious are not the right solution. But there are a number of solutions. And what we see, because a lot of fintechs come to us and say, great, you have amazing scale. How do we get on your platform? And the challenge that we oftentimes see is like, well, how does this, fall into the confines of existing regulation? Is it regulatory arbitrage in some ways? And are we comfortable with the risk? And that's just one simple example. So a lot of times I think it's the clarity of, hey, this is an innovation. I think, you were at the CFPB, and I think Project Catalyst, for example, was a great idea of there are certain things that we should be testing and understanding, and let's go and give safe harbor. Let's go describe the problem. Let's describe what we think the solution is going to be. But let's clear the red tape and the bureaucracy at times so that we can try these innovations to see if they have the impact that we want to the segments that we want.
So just to recap, there should be some sort of regulatory flexibility, at least open-mindedness to look at some of the new innovations to ensure that consumers are protected, but at the same time, look at the upside for consumers.
Yeah, I mean, I think if you're in the system, it works generally well. But the problem is we're not getting one on the margins. We're not getting more people into the system. And by the way that the system is defined and the way it works, it's actually hard to get the people who are excluded in by the. So, for example, right, if you think about ECOA, if you think about redlining requirements, right, you might actually want to get groups of the American public into the financial services systems. But by so doing and targeting a particular group, you might actually run afoul of another set of laws, right? And that's a very prime example of how sometimes the regulatory framework is actually keeping the most disadvantaged out of the system. Because you might want to create frameworks that are targeting them, but a lot of times, you have to go through so much red tape, and a lot of, banks and friends that I speak to, like, it's almost not worth the effort to actually do that, because in many ways you might just at the end of the day get your hand slapped for trying to do something good.
Okay, so let's switch gears to talk about trust, which is in the title of this fireside chat. So, according to Forbes, 78% of adults in the United States prefer to bank via mobile phone or online. Only 29% of Americans prefer to do in-person banking. These people probably are mostly boomers. No, I'm just joking. So the trend obviously is only accelerated by COVID, and we have heard this term neobank, right? So the rise of a neobank, Chime, Upstart, Upgrade, Affirm. These companies, whether they are still privately held or have gone public, they have commanded great market caps. So it seems consumers are feeling very comfortable, trusting their paychecks, their retirements, their lending, their savings, their investments with these fintech non-bank entities. So why do you think consumers are switching from the traditional, regulated, supervised, trusted banks to these guys who actually don't wear suits, they wear jeans?
Yeah, I think there's a couple of three reasons. I think the first is really around innovation, around pricing, right? I think a lot of the fintechs have been able to bring services to a group of people that historically were very expensive or not necessarily even wanted by many of the traditional banks. So, for example, when you look at some of the neobanks, right? The neobanks, I think in many ways have been the couriers of the fact that we now have close to $0 checking and savings accounts. Prior to that, if you didn't have direct deposit, if you weren't a consumer who could generate, let's say hundreds of dollars at least of revenue for a bank, they were going to charge you $30 a month. And now I think with the competition that creates, we've been able to lower the barrier. Now most banks don't have these particular fees. And I think that's an important aspect of what fintech is doing in terms of driving innovation and lowering cost. Secondarily, I continue to go back to this idea around certainty, transparency, and pricing. It is tremendously hard to determine which products are best for you, right? If you don't understand the complexities of underwriting, by the way, that's gotten much more complicated over the last 20 years with big data, with machine learning, right? It used to be the case that maybe you were 720, you're approved, and 719, you're declined. Well, that's understandable, and that's something that I think most consumers can operate in. But today, the credit decisions are oftentimes dozens, if not hundreds, of different variables. And, I know I couldn't solve it without our computers and our platform. And I'm 1,000% sure that consumers, an individual consumer, can't solve it. And I think those are, again, real problems that fintechs are bringing to the space, where they are solving problems, particularly of the most needy, that weren't solved before. So I think that's sort of a secondary component of it. And then if you think about just some of the innovation, right? You talked a little bit about paycheck to paycheck, living paycheck to paycheck, right? But the idea that, we can extend faster money, the idea that we can actually get money faster into people's hands, for example, during COVID and PPP, those are real innovations that I think are moving consumers forward, particularly in context of not having enough income, living paycheck to paycheck, not having $400 in savings.
Great. So other than crypto, AI is another thing that was being mentioned throughout the day today. So let's talk about generative AI. So it's all in, I can tell you almost every portfolio company that we invest in are either testing Gen AI, ChatGPT, or already putting, Gen AI into production. And yesterday, I was on the train to Philadelphia, my LinkedIn feed would just went a buzz about the Intuit Assist that just went live yesterday, and I talked to you this morning. So I'm a member of Credit Karma. Can I try it? He said, well, you're not in the pilot yet, so I'm really excited to see how that actually works. So I'm frankly quite surprised by the fast adoption of what Intuit probably is incumbents, but I'm talking about really traditional banks. My experience with the AI. When I was in the government, it was that it's a cutting edge stuff, but let's walk slowly. Let's not really touch it. Let those Fintechs try it first. But with Gen AI, the large language model LLM, looks like there's the adoption is really quick, really fast. So give us a few examples how you envision Gen AI, how that is going to really transform financial services.
Yeah, I mean, I think this is as big as the internet, right? And I think, I and many will go on the record to say that. I did not say that about Bitcoin, to bring it back to Bitcoin one more time. The reason, though, is if you think about what will happen and what AI will enable, one of the challenges in financial services is that every answer is really specific to the consumer. So, the best credit card for you, the best mortgage for you is actually differentiated based on what your use case is. And it's, it takes intelligence to figure that out. And obviously with Gen AI, the right data and the right capabilities, I think we'll actually be able to solve this problem at scale. We'll actually be able to help consumers give very specific advice. So to give you a very specific use case, I can imagine a world, and this is actually the one that we documented, and there are many others. You might come to Credit Karma and say, Credit Karma, how do I improve my credit score by 50 points so I can do X? Well, that's an actual use case that now with Gen AI, we can give a very specific set of answers, right? We can actually make the plan that says, you should go pay off this delinquent debt. You should make double payments on your XYZ trade line. And you should make sure that your DTI is below, 30%. That is a set of capabilities that will be powerful and transformative in the space. And when you add now the action to do that, I think that's when the idea that will change the world really comes into play. So in addition to that, you could actually then say, great, do that on my behalf, right? So let me direct my paycheck into, my favorite bank, and let Gen AI move those dollars for you. Allow it to pay your bills down for you. And that, I think, is how people get ahead. Take an example of a mortgage refinance. I mean, I imagine most people in here have had experience with a mortgage. We generally know when we can save money. And most of the time we could say, wow, I'd probably save $50. And what are we doing? We're subconsciously making a decision as to whether saving the $50 is worth calling a banker, sending in my W-2 statements, my tax returns, pulling credit, and then having a deal with a bunch of faxes. Well, this is a situation where Gen AI can do all of these things on your behalf. It can give you the reminder, it can do the work, and then say, well, great, your mortgage, refinance has been done. You're now saving $50 a month, and you didn't have to lift your fingers. I mean, I think that's the sort of innovation that this technology will enable, and it will help a vast majority of the most underserved, underprivileged, because it's on those levels that historically, it didn't make any bank, any company a lot of money to serve that group. And now you can do it at scale with technology. And I think that's why it's so alluring. And that's why I think it's so transformative.
So on the record, it's a real innovation other than, okay, got it. No, we're not going to talk about crypto here. So we got about 5 minutes left. I'm barely halfway through my questions, but I'm going to ask you a question about credit score. And cash flow underwriting. I know this is a topic of strong interest to a lot of folks. And tomorrow we have a small business panel that will talk about cash flow underwriting. So let's put small business aside. They just focus on consumer lending for a minute. So a lot of policymakers are very passionate about, excited about the promise of cash flow underwriting. And a lot of fintechs are, as you know, some of them are publicly traded, are actually actively using cash flow in their underwriting decisions. They believe that it's a great way to open the credit box so that traditionally unserved consumers can get access to credit. So, and you are the expert on credit scores. So I'm curious about your view on is credit score sort of out of fashion? Are they still predictive? And what's your take on cash flow underwriting? How useful do you think they are to help a consumer to get a loan?
Well, I think first, I'm not a proxy for the credit bureaus, right, or the credit scoring industry. What I have seen over my last 20 years of experience in the space is they still are the most predictive element of underwriting. And, if you look at all the prior players, and again, I'm going to keep this in the context to consumers, cash flow information is tremendously powerful as an addition to credit, right? Now, I've seen a lot of companies come and go that focus solely on and said they have a better mousetrap than credit. And again, I'm not beholden to credit. I think any data element or group that is more predictive, we should use those. But what I have seen, at least in the last 20 years, is that, sort of when the tide is going up and everything is going up and to the right, that's when most of these companies will come out and say they have a better mousetrap. The problem is when the economy tanks or when there are some macro level shocks, and that, you have real systemic risk that they aren't able to capture, sort of that predictability. And I think that's the challenge. So there may be new technologies, there may be new data sources. That cash flow may work better now, but I think it's actually unproven until you get to your first crisis, your first recession. That's the real determination as to whether this is successful. And at least history has shown me that credit with cash flow is fantastic. Cash flow by itself in the consumer context, it still, remains to be proven.
So we are likely going to have either a soft landing or maybe a mild recession, hopefully mild, in the next 6 to 9 months. So we'll see probably some of the players that, we'll see whether Ken is right or wrong on this one. We got 2 minutes left. So I'm going to ask the audience, do you have any questions? Okay, no takers. So I'm going to keep asking about credit score. So there's a Wall Street Journal article on July 12th about credit score, and basically the articles actually cited some of the numbers from Intuit that about 25% of the subprime consumers actually saw a credit score as much as 88 points increase during COVID, and thanks to stimulus checks and the temporary pause on student loan repayments. So the main point of this article is that the author believes, the reporter believes that there's inflation in credit score. Hence, it fails to really predict the delinquencies which we are seeing now, increasingly, especially among the subprime borrowers. So what's your take?
I would argue the complete opposite, right? I think it completely validates how credit scores work. So if you're really into, how the sausage is made, right? Our credit scores are used to effectively predict defaults 2 years in advance. And if you think about the COVID period, what happened is this sort of increase that you're talking about. Well, we had an incredible amount of cash and liquidity hit consumers. We had a pause in student loan repayments, right? And, we had a lot of forbearance programs. So really the disposable income of a vast majority of consumers moved up, right? And as a result, we had all-time lows in delinquencies during sort of that first period of the COVID recovery. And in many ways, that's exactly what the credit scores were predicting, right? Was that there would be lower default rates in an environment like that as the debt load of most consumers was greatly reduced. Now, obviously, the economy is changing, and to your point about soft landing, they're adjusting. But to the best of my knowledge, that bump that we saw was a function of the period where there was vast majority of liquidity. There was sort of a relief on the debt programs, and this credit score is supposed to calibrate, right? They are actually supposed to index to a certain default rate to really get into the weeds of credit scores, and that's exactly what's happening. So, again, I think I'm a statistician by trade, so I think that they work amazingly well for what they are. You can't. They're probabilities, right? And the probabilities and the calibration of those probabilities is actually working as expected.
With that note, we're 1 minute over time. I would like to thank Ken for this interesting, stimulating conversation. Thank you.